On the 30th of June 2026, a hedge fund in San Francisco closed the first half of its year with a number that most people in the industry did not believe when they first heard it. Up 439%, net after fees in 6 months. 30 days later, the same fund sold every public share it owned, the long positions and the short positions together, in a single block trade, to a single buyer before the market opened. The fund is called Situational Awareness, is named after an essay. The man who wrote that essay is 25 years old. I have spent most of the last 2 days reading the reporting on this, and I want to walk through it carefully because the version going around online is wrong in one specific way. A lot of posts are saying the fund is finished, that it went to zero. That is not what the reporting says. What actually happened is more complicated, and I think a lot more interesting. So let me go back to the beginning. Leopold Aschenbrenner was born in Berlin to 2 doctors. He was educated at the John F. Kennedy School there. He left for the United States as a teenager and enrolled at Columbia University, graduating in 2021 at 19 as valedictorian with a degree in economics and mathematics with statistics. While at Columbia, he co-founded the university's Effective Altruism chapter. He did research at Oxford's Global Priorities Institute, co-authoring work on long-term risk and economic growth. In 2022, he joined the FTX Future Fund, the philanthropic arm attached to Sam Bankman-Fried's crypto exchange. He left before the exchange collapsed later that year. In 2023, he landed at OpenAI on the superalignment team, working under Ilya Sutskever and Jan Like. That team existed to work on a specific problem. How do you keep control of AI systems that are more capable than the people supervising them? He was 21 years old. I want to flag this early because it shapes everything that follows. Almost nothing in this story is a normal career path, and everything happens at a dizzying speed. At OpenAI, he wrote an internal memo arguing that the company's security was, in his own words, egregiously insufficient to protect against the theft of model weights or key algorithmic secrets from foreign actors. He was specifically worried about industrial espionage by state-backed groups, and he named China. He shared it with colleagues and with some of leadership. Then, after what he has described as a major internal security incident, he sent it to members of the board. He has said the reaction was immediate and negative, that leadership was unhappy the board had been given it, and that he received a formal warning from Human Resources. In April 2024, OpenAI fired him. The company's stated reason was the leaking of internal information. Aschenbrenner disputes that characterization. He has said the document in question was a brainstorming file on preparedness, safety, and security measures on the path to AGI, that he shared it with 3 outside researchers for feedback, that it was cleared of anything sensitive, and that this kind of sharing was normal practice at the company at the time. He has also said he was told directly that the security memo was a major reason for his dismissal. OpenAI publicly rejected that account and said the concerns he raised did not lead to his separation. 1 month after he left, the superalignment team was dissolved. 2 months after being fired, in June 2024, he published a 165-page essay series called Situational Awareness, The Decade Ahead. He put online for free, under his own name. The core claim was that if you take the trend lines in compute, algorithmic efficiency, and model capability, and simply extend them forward, artificial general intelligence by around 2027 is, in his phrasing, strikingly plausible. From there, he argued that AI systems capable of doing AI research would compress a decade of progress into less than a year, producing what he called an intelligence explosion and then superintelligence. He framed the whole thing as a national security problem first and a technology problem second. The part that mattered for markets was different, and is the part most readers skipped. He argued that the binding constraint would not be ideas. It would be physical. Electricity, transformers, land, cooling, memory, power contracts signed years in advance, trillion-dollar compute clusters, hundreds of millions of chips running at once. The essay went genuinely viral, far outside AI circles. Ivanka Trump praised it publicly. Policy people in Washington circulated it. It handed a lot of investors a ready-made list of what to buy. And then the person who wrote that list decided to trade it himself. In late 2024, he launched Situational Awareness LP in San Francisco with roughly $225 million. He took the roles of chief investment officer and managing partner with essentially no professional investing background. The backing list was unusual. Patrick and John Collison, the founders of Stripe. Nat Friedman, the former head of GitHub. Daniel Gross. Later, the quantitative trading firm Jane Street became an investor, which is worth noting because Jane Street very rarely allocates money to outside managers. The first public equity disclosure, covering December 2024, listed 6 holdings worth about $255 million. It was predominantly power and chip companies. There was no crypto exposure at all. By the first quarter of 2026, that same filing listed 29 holdings, and roughly a quarter of the disclosed book was Bitcoin miners. That shift is not random, and it is not a change of mind. Is the essay executed? Miners already own the 2 things the thesis says are scarce, which is contracted power and land with cooling already built. So the miners stopped being crypto companies and started being data center companies, and this fund was buying them while that was still a minority view. Here is what the portfolio looked like based on the first quarter filing and the reporting that followed. The long side was concentrated in what you could call the second layer of the AI build-out, not the famous names. The suppliers. Bloom Energy for power generation. SanDisk and Micron for memory and storage. CoreWeave for GPU cloud capacity. Nebius. SK Hynix in South Korea. Then a long list of miners turned data center operators. Core Scientific IREN, Applied Digital, Riot Platforms, CleanSpark, BitDeer, Hive, Cypher, HUD-8, White Fiber. Plus power and infrastructure names like Solaris Energy, T1 Energy, and Babcock and Wilcox. Reporting also describes very large put positions against a semiconductor index and against NVIDIA, and short positions in software companies, including Adobe. So the structure was long the physical bottleneck, short the incumbents the market had already repriced for AI. The concentration was extreme. Reporting on the first quarter filing indicates the top 5 positions were more than 3/4 of the disclosed long book, and that the fund held roughly 8% of the shares outstanding in one of the miners. That concentration is exactly why it worked. It is also exactly why it broke. For a while the results were close to unprecedented for a fund of that size. 47% net in the first half of 2025. Assets around $1.5 billion by late that year. Then 2026 accelerated. By the end of May, the fund was reported up roughly 270% after fees for the year, and more than 1,000% since launch. Assets passed $20 billion, putting it in the same size range as long-established names in the industry, built in under 2 years. There was also a private position, and it may turn out to be the most important detail in the entire story. In February 2025, the fund invested in Anthropic at a valuation just above $60 billion. By mid-2026, Anthropic was valued at $965 billion in share sale. That single stake grew to roughly $5 billion, about 1/5 of the fund. Then came the half-year letter, dated the 24th of July, reported by the Financial Times. 439% net for the first 6 months of 2026. At that moment, by return, Situational Awareness was the best-performing large fund in the world. Now the other side. July 2026 is the month the AI infrastructure trade broke. SK Hynix listed American depository receipts on NASDAQ around the middle of the month, raising about $26.5 billion. In hindsight, a lot of people are treating that listing as the top of the cycle. Its shares and SOL fell more than 15% on the same day. The Korean market dropped about 9% and hit a temporary trading halt. It got worse. On the 29th of July, SK Hynix reported second quarter operating profit up 557% from a year earlier, and the stock still fell close to 10% because the number came in under the market's expectations. By that point, the company had lost roughly 45% of its value in about a month, more than $500 billion of market value. Chip stocks globally shed more than $1 trillion. NVIDIA alone lost more than $200 billion over a few sessions. The NASDAQ 100 fell about 10% from its June peak. And the fund's core long positions Nebius, SanDisk, Micron, CoreWeave fell somewhere between 27 and 54% inside a single month. So how does a fund that is up 439% get destroyed 4 weeks later? The answer is leverage. Reporting puts the fund's gross exposure at as much as 4 times. That means for every dollar of its own capital, it controlled around $4 of positions. On the way up, that multiplies returns and is a large part of how you reach 439% in 6 months. On the way down, the arithmetic is unforgiving. If a long book is levered 4 times and it falls 30%, that is a hit of roughly 120% of your own equity before anything else happens. And other things did happen. The hedges were the wrong hedges. Puts on a semiconductor index held against long positions in smaller and far more volatile infrastructure companies look like protection on paper. But they respond to the same underlying driver, and in a stress event, the high volatility, longs fall much harder than the hedge can gain. At the same time, the software shorts went up rather than down, so the short side added losses instead of offsetting them. Long side falling, short side moving against you at 4 times leverage. Once your equity approaches the maintenance threshold at your lender, you are no longer the one making decisions. Your prime brokers are. The sequence is worth going through slowly because it is unusually well documented. On the 24th of July, the investor letter goes out. Aschenbrenner acknowledges that the fund has not been immune to the swings, particularly in Asia, then describes the sell-off as creating some of the most attractive opportunities since early 2025, and invites investors to add fresh capital starting the 1st of August. Over the following days, the fund approaches existing investors and lenders for money. It offers some of them portfolio assets directly. One person briefed on those conversations described them as ad hoc rather than an organized fundraise. The prime brokers, Bank of America, Goldman Sachs, and J.P. Morgan Chase, are issuing margin calls and working to either satisfy them or reduce positions in an orderly way. They begin quietly marketing holdings from both sides of the book. Then, before the open on the 30th of July, the entire public equity book moves in one transaction. CNBC's David Faber reports it first. The Wall Street Journal identifies the buyer as Ken Griffin's Citadel. Millennium and Jane Street are both reported to have looked at the book, with accounts differing on whether they bid or passed. 6 days from best-performing large fund in the world to forced seller of everything. There's one more detail about that week. Aschenbrenner was getting married that same weekend. Fortune, citing Wall Street Journal reporting, said the wedding was planned for the weekend of the 31st of July in Carmel, California. Unfortunately, he had to sell his entire portfolio in the week of his own wedding. This is the part where I want to be careful, because this is where most of the online commentary is wrong. The fund did not go to zero. It is not shutting down. Bloomberg reports that assets have fallen to around $10 billion, down by more than half from recent months. That is a severe loss. It is not a wipeout, and the difference matters. The private holdings were not sold. The largest is the Anthropic stake, valued at roughly $5 billion, and a spokesperson told CNBC that reports the fund was shopping that stake are not accurate. There are other private positions as well, in companies like FluidStack, MADX, and T1 Energy. So what remains is a firm that will operate mainly as a private investment vehicle with a very large Anthropic position at the center of it. And there is one detail here that is hard to ignore. Anthropic filed confidentially for an initial public offering on the 1st of June this year. Aschenbrenner's own July letter named a potential Anthropic listing as a catalyst for the second half. He is also engaged to Avi Talbot, who is chief of staff to Anthropic's chief executive. I am not drawing a conclusion from any of that. I am only noting that the asset he has left is the one closest to him. There is a theory circulating that I want to address directly because it spread very fast and is not supported by the evidence. The claim is that Citadel talked the market down in order to buy the book cheaply. What people point to is that a macro strategist at Citadel Securities published a note on the 27th of July saying he now expected an interest rate increase at the July meeting. The market sold off, and 3 days later a Griffin firm bought the portfolio. Several things weaken this. Citadel Securities and Citadel are separate firms with different businesses. Other institutions published the same rate call in the same week. The market's nervousness was already being attributed to energy prices and a strong labor market before that note appeared. And the central bank did not raise rates, although 3 of its 12 voting members wanted to, which was itself the first time since 2016 that 3 officials dissented in the same direction. Nobody outside the transaction knows what Citadel paid. It may well have been a very good price, but a good price in a forced sale is a normal outcome, not evidence of a plan. I would treat that story as speculation until someone produces actual evidence for it. Here is the part one keep coming back to. Aschenbrenner's thesis may well be right. The argument that AI progress runs into physical limits, power and memory and cooling and land is not obviously wrong, and much of what happened between 2024 and 2026 supports it. His returns before July were not luck in any simple sense. He identified a genuine bottleneck before most institutional investors did, and he sized it aggressively. What broke was not the idea. It was the structure built around the idea. Concentration plus leverage removes your ability to be early. If you are right about a 5-year outcome, but you are levered 4 times, a single bad month can take the position away from you long before the outcome arrives. A few things I will be watching from here. Whether this was a clearing event or a first step. Some commentators argued on the day that removing a forced seller marks a bottom for the AI infrastructure trade. Chip stocks did rise sharply that same session, although strong results from Microsoft the night before probably explain more of that than one block trade does. Whether other funds were positioned the same way. Concentration in this theme was not unique to this one firm, and prime brokers have been issuing margin calls across the sector. Whether the Anthropic listing actually happens, and at what valuation, and whether Aschenbrenner rebuilds. He is 25. He still runs a firm with roughly $10 billion and a large stake in one of the most valuable private companies in the world. That is not a career-ending position. It is, however, a very public education in the exact thing his essay was named after. One note before I finish. Nothing in this video is financial advice. I am not recommending any action on any of the companies mentioned, and every figure here comes from press reporting that is still developing as I record this. If numbers move after this goes up, treat the reporting as the source and not me. Thank you for watching. I will keep following this one.